if you're buying MicroStrategy today at 2 times NAV or a 2x premium, you're effectively buying like half a Bitcoin as opposed to about 1 Bitcoin being a spot, right? Which seems irrational. But MicroStrategy has proven over time by using financial engineering, whether that's selling a stock or selling converts in an accretive way, they can actually acquire more Bitcoin. And there's this new metric that people should focus on, which is Bitcoin per share. And so you're saying if you're buying MicroStrategy today at half Bitcoin per share, if they can grow that Bitcoin per share 50% a year for 2 years, after 2 years, you have 1.1 Bitcoin per share. So you're actually better off if they can grow Bitcoin per share quickly by owning MicroStrategy at 2x premium than just buying 1x Bitcoin today.
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. Every episode, we're featuring your comments. Here's what Hugh Naylor on Farcaster had to say about our recent REV debate between Tom Dunleavy and Austin Federa. Love these spicy takes, whether agreed with or not. I get tired of podcasts where people always agree and or say the uncontroversial. Do you agree or disagree? You'll have to tune in and let us know. Write a review of the podcast overall or leave a comment on our video on Farcaster, YouTube, or X. This is the May 30th, 2025 episode of Unchained. Imagine an AI that speaks crypto and does the work of a team of analysts. Introducing Focal by Falcon X, bringing clarity to a world of noise. Visit askfocal.com. Bitkey is the Bitcoin wallet from the team behind Square and Cash App. It's the first 2 of 3 multi-sig hardware wallet with recovery tools that replace the need for a seed phrase. Get 20% off with code UNCHAINED. Today's guest is Cosmo Jiang, General Partner and Portfolio Manager for Liquid Strategies at Pantera Capital. Welcome, Cosmo.
Hey, Laura. How are you? Nice to be on.
Nice to have you. The crypto treasury companies trend is in full swing. This week alone, Trump Media got in the game by announcing it was raising $2.5 billion to buy Bitcoin. Publicly traded Sharplink Gaming raised $425 million to create an Ether treasury company. GameStop announced a $500 million purchase of Bitcoin, and Vivo Power raised $121 million to launch an XRP treasury. Why do you think we're seeing this trend take off now?
It's a great question. I think there's a little bit of a product of history and the right moment in time. As far as a product of history, I'd say in a lot of ways, we at Pantera sort of unwittingly started this trend a few months ago when we structured and seeded the first deal in the US, which was a DeFi Dev Corp, or at the time known as Janover. And it received really strong market reception, certainly stronger than we had originally underwritten. And as people saw that, pretty soon thereafter, there were a couple more deals, notably the Cantor deal, where there was a Cantor D-Spec that raised close to 700 million. And I think that really made people realize that, wow, there's a really big opportunity here. And that there are really big, serious people getting in. The Cantor deal was obviously backed by Tether and SoftBank. And after those 2 deals, I'd say over the last 2 months, I've taken 50 pitches now of people trying to do something similar, which is pretty crazy. And we've seen a lot of these deals now come to market after seeing the success of DeFi Dev Corp and Cantor Equity Partners. And so that's sort of the, you never know when trends get started, but they did, and that did with DeFi Dev Corp a month ago. And now we're here with a lot of people want to recreate that success. I think the other reason why they're taking off now is more related to the larger capital markets, which is that it's pretty clear there's a very strong appetite for crypto-related equities. And I say that because this year has become a coming out moment for the crypto industry where there's regulatory clarity coming. And so traditional equity investors now feel the need, the demand, the desire to get access to crypto-related exposure. You're seeing that show up in crypto-linked stocks like Coinbase or Coinbase or Robinhood or Galaxy. We're also seeing it show up in IPOs like eToro, priced way above the range, largely because of its crypto association. Circle's IPO is generating pretty strong demand, also because of the crypto association. So there's very clearly really strong appetite for crypto-linked equities. And then, by the way, one great instantiation or way to represent that is through these digital asset treasury companies.
Yeah, and of course, the granddaddy of all these companies is MicroStrategy, or formerly MicroStrategy, now Strategy. Let's talk a little bit about how these companies are structured because it seems that they're all using sort of like different terms to raise money for these purchases of, usually Bitcoin, but sometimes other cryptos. What are the different types that can occur? And, if you could even also lay out like which ones are riskier than others, that would be helpful.
Yeah. Let's start with their two large types of transaction structures, and then there's a few different tools they can use within those transaction structures. So, the two most common types of transaction structures we've seen are one, you can either go through a SPAC route, and so they're large SPACs are basically large blank check companies that have a lot of capital. Cantor Equity Partners is the largest D-SPAC in the last couple of years, and they'd raised a bunch of capital and they added on they did a reverse merger with a Bitcoin holding entity called 21 and added on an additional PIPE and PIPE, which is a private investment in public equity and convertible debt raise. So there's the de-SPAC route, which is take a large blank check company and then effectively take this treasury company public. And then the other route, which has become much more common because it's faster to market, is finding a what I would lovingly call a Nasdaq listed public company that is perhaps very small, microcap, and in a lot of cases either clearly a shell company or something that just hasn't succeeded in what they'd like to do, and so trading at a very low market cap. The idea of using a Nasdaq listed company is because that way you get access to the U.S. capital markets day one. It's already listed on Nasdaq, and it's much quicker to raise capital and use all the tools that are available to you in the financial markets if you're already a seasoned issuer, or in other words, a public company for more than a year. And so we've seen most of the new forays be going to find these Nasdaq public companies, these Nasdaq shell corporations, where you can then where they then raise a large amount of capital to begin acquiring crypto. So those are the two routes, either SPAC or a public shellco. I'd say, the tools that you have available are really twofold. You can either raise debt or you can raise equity. When you're raising equity, it's through a PIPE or a private investment in public equity. And when you're raising debt, it's likely going to be through a convertible debt offering because people who want to participate in this want equity-like upside, which you get in convertible debt as opposed to normal debt. But you also get downside protection if you participate in convertible debt that a public equity investor wouldn't get. So those are the two major types. It seems like most of the capital has been raised in the PIPE format rather than the convertible debt format. And that's because, what we've seen is that, at least in the first few deals, most of the participants in these deals are people who already own the underlying asset, whether that's Bitcoin or something else. And so for them, they're already have that Delta One exposure to the underlying asset. They don't care, or they're indifferent if Bitcoin goes down in price or goes up in price. They're already long Bitcoin. And so for them, investing in a common equity type structure makes a lot of sense, and they don't need the downside protection. As we see these deals get bigger and more mature, and certainly with the larger deals like the DJT deal, you're going to attract much more traditional finance investors, and they want the downside protection. So you'll see more convertible debt structures and larger, more mature deals, and a lot more pipes in these smaller deals that are mostly crypto natives.
And if, like, from an investor standpoint, are certain, either structures or, ways of financing the purchases, are they considered riskier or better or just different?
Yeah, they're definitely different, but there's some that are more riskier than others. So from a really comparing the PIPE versus the convertible debt, a PIPE is effectively you own common stock, and so with common stock you have obviously downside to zero or unlimited upside, but you get it at the price at which your entry is, and so you have the full spectrum of return outcome. So it's higher risk reward. With a convertible debt note, you have downside protection because it is debt. Oftentimes it's collateralized by tokens in the Treasury. And so, if you're investing in convertible debt offering, you get the downside protection of not losing your principal, except in a really bad scenario. And then but your upside is limited. Your generally convertible notes have a conversion option that's 30 or 35% above the existing price. So let's say something trades at $10. If you're a PIPE investor, you buy it at $10. If you're a convertible debt investor, you're downside protected below $10, And at $13, you can then convert into common equity. And so you sort of lose the first 30% of upside, but you get the downside protection.
Okay, so some of these companies are also solely devoted to the crypto acquisition or the crypto treasury strategy, and others tack that strategy onto another business. And I wondered if you thought there were any types of companies that, like this strategy of trying to acquire crypto is better or worse for. Like, do you think it makes more sense for a company to do it if they already have a core business, or is it for one that is just purely an acquisition vehicle?
Yeah, my preference or has been for those that are more simply pure play acquisition vehicles. And the reason for that is because generally in the public markets people want simple digestible stories, not just because it's easier to understand and underwrite, but also because it shows you that management is focused on executing a specific thing. Equity investors like being able to choose between different strategies. That's why conglomerates, there's a big wave in conglomerates and the equities in the 50s, and they all got broken up and torn down over time because equity investors became more discerning about wanting specific exposures. And management teams also understood the benefit of being focused. So generally, I like things that are going to be very pure play. And so I find the pure play digital asset treasury companies where all companies have to have an operating company in order to be listed on NASDAQ. But if it's a small operating company that's sort of de minimis in value, or a operating company that's very clearly synergistic or linked to the acquisition of underlying tokens, I think that makes sense. But if you have a very large side business that's associated with it, as in, one might argue in the DJT acquisition, they had a $5 billion Truth Social vehicle. It's not super clear whether Truth Social is driving the $5 billion of value or not, but regardless, it's sort of this $5 billion thing that existed, and they added $2.5 billion on top. It's like the digital asset piece is just too small of the whole piece of the pie. And so I think that as a result is not getting a great reception. Whereas those that are much more pure play don't really have a large underlying business, like the DFDV or like Cantor Equity Partners, those are performing well because people like that it's so simple and easy to understand, and the management is focused.
All right. Well, a month ago, there were also a number of Solana acquisition vehicles that launched, Upexi, Sol Strategies, and as you mentioned earlier, DeFi Development Corp. It was surprising to some that there were Solana ones even before there was an Ethereum one. And, as I mentioned earlier, there also this week was this XRP one that was announced. Which types of crypto assets do you feel like make more sense for to serve as the underlying for these publicly traded acquisition vehicles?
I think it's important to take a little bit step back and understand the context of why these vehicles even work to begin with. And it really comes down to a few things, right? In order for the fundamental premise is that if they trade at a premium, they can continue to acquire more tokens in an accretive way over time. And so, why should something trade at a premium? Well, it really needs a lot of retail attention and really strong marketing and awareness. Otherwise, it's just not interesting. Like if we're going to choose, crypto asset number 100, there's probably very few people in the equity markets that know it or are interested in it, and so you're not attracting new incremental capital. You're not really getting a lot of buzz. So it has to be a very widely recognized asset, and also not just a widely recognized asset, but an asset that a lot of people want, and preferably an asset that is hard to access. And so, Bitcoin has done really well. And MicroStrategy did really well because at the time when it launched, it was very hard for people to access Bitcoin. It's continued to do well because there is just such strong appetite for Bitcoin in the public markets. Naturally, the list of assets that are widely known and also are that are easy to market or attractive to market to a larger set of investors is pretty limited. I'd say I'd be surprised if you go beyond, call it the top 10, top 20, but maybe even top 10, that these really have enough widespread, retail awareness for it to be interesting as an asset. But within the top 10 or maybe the top 20, I think there's a lot of reason to believe many of these could work. They just need to come out with a really clear message and a really clear marketing plan to attract this broad set of investors. So when you look at Bitcoin, it's very obvious. When you look at the next runner-up asset, at least in our conversations, I spend a lot of time talking to institutional investors and large, private wealth clients, and it's pretty clear in all of our conversations that that Bitcoin is probably 95% of the conversations that people are having when it's talking about entering crypto for the first time. But the next most commonly talked about asset is Solana. And so for me, as I was looking at these deals, DeFi Dev Corp really stood out to me because it's pretty clear there's demand for Bitcoin, but it felt like the second most likely asset that could generate excitement was Solana because it is the second most talked about asset by the LPs that I talk to or the color that I get from them. It is truly a fast growing asset that has a lot of upside, certainly relative to a $2 trillion market cap token like Bitcoin. Solana probably has more upside over time. And that there's like a slightly different story in that there's a real fundamental story behind Solana versus Bitcoin is digital gold. So it's unique enough to really stand out. And that's why I think we've seen DeFi Dev Corp and the other Solana digital asset acquisition vehicles do well. Clearly, we've seen ETH and XRP come out next. I think both of those also are great assets that a lot of people understand and are aware of. And so they also stand a really good shot of making it work.
All right, so in a moment, we'll talk a little bit more about the different crypto assets that could serve as the underlying for these different acquisition vehicles. But first, a quick word from the sponsors who make this show possible. Markets are ripping, but not every pump is created equal. You need to make sense of the action and what's coming next. But where do you start? Meet Focal by Falcon X, your AI-powered crypto analyst. It's like having a legion of experts at your fingertips, ready to break down market-making events, chart protocol TVL, and track ETF flows. Get clarity in a world of noise with Focal. Learn more at askfocal.com. Here's another listener comment responding to Tom Dunleavy and Austin Federa's RIV debate on a recent episode. On YouTube, Sean M. Crypto Dad said, "No one wants to pay ETH fees, period. We all moved to Solana because the UX was a million times better, the cost to transact is a million times cheaper. Trying to move your money around from ETH to the L2 is not straightforward and simple for a non-crypto person. People don't have to deal with those issues on Solana." If you have a hot take, let us know. We're listening. Leave a review of the podcast overall, or leave a comment on our video on Farcaster, YouTube, or X. Back to my conversation with Cosmo. So it sounds like the reason, because, when we saw the trend with the Sol acquisition vehicles, people were wondering, like, why is this not for Ether? But it sounds more like the LPs that you were talking to were more interested in more upside. And because Sol is kind of like at an earlier stage, that was sort of why they were focused there. Is that the reason? Because obviously with Ether being the second largest crypto asset and having been around for what will be 10 years in 2 months, it seemed like, I don't know how to phrase this, but I think it was surprising to people that we didn't see the trend with Ether earlier. So can you just dive into a little bit more, explanation there of why we saw it with Sol before ETH?
Yeah, I want to be pretty clear that I think ETH is clearly a very established asset that a lot of people recognize. And I think, we recently made an investment in Sharplink Gaming, which is the new ETH Treasury vehicle that's backed by Consensys. And, I'm a strong supporter of that team, and I think they're going to do very well. I think the reason for Solana vehicles coming out before ETH is just as much about the asset, but also about just the opportunity that's out there, or the opportunities that get presented. For these things to happen, you need a confluence of a couple of things. You need there to be management teams that are dedicated to trying to do this, and you also need a set of investors that are interested, that are available, and capital available. So on the capital available front, clearly there's capital available for both Solana and ETH Treasury vehicles. I do think it's the momentum in Solana has been strong over the last couple of years, and so the relative appetite, at least amongst my vantage point of everyone outside of crypto, is higher for Solana than it is for ETH, and it has been for some time. But that could change, and clearly there's still strong appetite for ETH. From a management team perspective, DeFi DevCore wasn't the first pitch I've taken. I've certainly taken a number of pitches prior to that, and it's but they were the first team that launched in the U.S. with a really strong, with what I thought was a really strong view and a really strong probability for success. And so they happened to be the first one to get started. The first one that started in the U.S. happened to be a Solana one because that was what the team chose. So there's a little confluence of both those reasons.
Yeah, although there was that failed Ether one in January or February. So
Yeah.
it's not just timing.
Yeah. There is I guess there's like a minimum. So for these to work, there's a minimum viable scale as well, right? And I think the earlier ones didn't get enough scale off the bat.
Like, meaning they didn't have enough backers or buyers, like, from the get-go?
Right, exactly.
Okay. And then just out of curiosity, you said that you felt like it could also work for the XRP one. That one's a little bit different in that XRP, doesn't have kind of like the same level of usage as these other chains, or hasn't quite proven itself. And obviously, Ripple is trying to do things to give it more utility, like the Circle acquisition, offer or discussions of acquisition. Um, so I just wondered, like, for that particular asset, because such a huge portion of the supply is owned by one entity, like how does that affect, that treasury company?
Yeah, I think that it's a great question, and obviously one of the risk factors that anyone has to keep in mind when they're buying XRP the asset or XRP the treasury company. But I do agree that is a risk factor that people should be aware of. We weren't investors in the XRP deal recently, but a lot of that was because of the complexity of the structure of this XRP treasury acquisition vehicle. I think the reason why it might succeed is because sort of beyond the comprehension of a lot of crypto native people, including myself, is XRP clearly has a really, really strong following. There's a lot of social media influencers that are really into XRP. There's a lot of what I'd call it has a lot of really broad awareness amongst institutions and traditional finance. If these vehicles succeed based on their awareness and marketing capability, Ripple has proven out over time by its market cap that they clearly have a very strong marketing engine and brand building awareness engine, and it again hard to comprehend from a crypto native perspective, like where that comes from, but it you can't deny that exists, and that's why I think it might work.
Okay, so one other thing, Matt Levine of Bloomberg wrote about these companies, quote, US public equity markets will pay about $2 for $1 worth of Bitcoin. So why is it that our investors willing to do that? And which types of investors are willing to do that? What could they do with a share of one of these Bitcoin treasury companies that they can't do with, like, for instance, a share of a Bitcoin ETF?
Yeah. I think there was a little bit of the nuance that was lost in Matt Levine's blog post, actually. And it is that there are actually a lot of fundamental value investors who own MicroStrategy. So, just for a little context, like I come from traditional equities. I've done long short equity most of my career, and I'm like a blue blooded, deeply fundamental value guy. And so for me, MicroStrategy felt like this weird thing that never made sense, because why should something trade at two times its underlying NAV? But sort of in the light of, as an investor, you need to constantly test your pre-existing biases, and in light of the just continued persistence of the MicroStrategy premium for a long time, and by the way, even after the ETFs launched, and the buy-in from really fundamentally oriented funds, whether that's Capital Group, which is the largest mutual fund company in the world, or Norges, the Swedish sovereign wealth fund, who own MicroStrategy in size, there clearly is something going on. So as I dug in to understand that and sort of test my fundamental value case, I started to realize that there is actually a rational reason why these should trade at a premium, and it's not just that there is a rational reason that you can believe these should trade at a premium, and that fundamental bull case is really premised on a couple things. Like, if you're buying MicroStrategy today at two times NAV, or a two x premium, you're effectively buying like half a Bitcoin as opposed to buying one Bitcoin via spot, right? Which seems irrational, but MicroStrategy has proven over time, by using financial engineering, whether that's selling a stock or selling converts in an accretive way, they can actually acquire more Bitcoin. And there's this new metric that people should focus on, which is Bitcoin per share. And so you're saying, if you're buying MicroStrategy today at half a Bitcoin per share, if they can grow that Bitcoin per share 50% a year for 2 years, after 2 years you have 1.1 Bitcoin per share. So you're actually better off, if they can grow Bitcoin per share quickly, by owning MicroStrategy at 2x premium than just buying 1x Bitcoin today. And last year MicroStrategy grew its Bitcoin per share by 74%. So there is evidence to suggest that they can grow Bitcoin per share very quickly. And so if you believe that to be true, it's actually rational for some people, including very large traditional finance fundamental value allocators, to go buy MicroStrategy or companies like that, because you can grow your coin per share faster than owning the coin itself.
Well, now let's talk about the downsides, because there is concern, or potential downsides. There's concern that this could create leverage in the system and perhaps create some kind of systemic risk that would be equivalent to the role that GBTC played during the series of crypto collapses that we had in 2022. Mike Ippolito of Blockworks tweeted, quote, "It seems like we found the 2025 equivalent of GBTC. I have no idea if these vehicles will achieve that level of scale and destructive potential, but make no mistake, this is leverage getting injected into the system. To spell out the risk, it's that these acquisition vehicles accumulate a lot of crypto at much worse terms than Sailor and eventually become forced sellers. It's an extremely reflexive feedback loop that, if it gets large enough, ends in a 2022 like sell off. So, what do you think of what he said there?
Yeah, I think I think the broader point that this certainly a pocket of reflexivity in the market is certainly true, and it's a risk. I would say that some of the detail is perhaps lost in what you said, which is that these companies are only forced sellers if they have a capital problem, right? And the capital problems are either caused by cash flow, negative cash flow, and the need to fund expenses, or by having debt. And by far and large, these new companies are largely financed by equity, not by debt. So if you don't have leverage, it's highly unlikely you come into a forced seller situation. Most of these don't have leverage. There are some that do have leverage and some that are taking on debt. And so that creates a little bit of risk. But my view is that for many of these, they're not going to be forced sellers. Some of them will, but most of them are not. And so if anything, it's actually just a pretty price insensitive buyer who's effectively locking up tokens or locking up coins for forever. And so it's a little bit scary in that this is clearly getting a lot of traction very quickly, and usually those things don't end well. But if you look at the actual structure, very few of them have debt, so there's very little forced selling concern here.
And do you see any trends happening with like real world assets and these stocks and DeFi kind of combining in any interesting way? Like if the tokenized stock trend continues, then that combined with this trend, could that lead to any kind of systemic risk in crypto?
I mean, the beauty of stocks, the beauty of these closed-end vehicles is that it sort of doesn't really matter where the stock trades. They they aren't forced sellers, even the stock goes to like a dollar, it drops 50%. And so I do have questions about the volatility of these equities. Like I think that volatility of these equities is going to be very severe, and especially in downturns, it's going to be very reflexive. But if you think about it from the perspective of an owner of the equity, there's definitely a lot of risk involved and a lot of volatility involved with buying these equities. People buy them for that risk, right? People like that they're volatile, and that's why people are buying them. But they have a lot of risk. If you think about it from a crypto native perspective, from people who own the underlying token, whether that's XRP or whether that's Bitcoin or Ethereum or Solana, I think it's like the volatility of the equity almost has nothing to do with whether or not they're going to sell the underlying token. So they're kind of separate. Sentiment wise, they might not be separate, but like fundamentally, they're very separate. And so and so you know all that worries me a little bit about being an owner of the equity, although I think they have a plenty of upside. But as an owner of the underlying, as an owner of Bitcoin, ETH, or Solana, it doesn't worry me at all.
Okay. And when you look at, the different types of vehicles, and, as you said, you're an investor in a number of these, how would you value them, or how should investors kind of think about it when they're looking at them?
Yeah, I think the most important metric to look at is, well, there are two very important metrics to look at. One is certainly the premium to NAV. The metric that maybe we're grabbing around towards is MNAV, or the amount of Bitcoin NAV that you own, or Treasury token NAV that you own. So just understanding the valuation of it, what kind of premium to NAV does it trade at? MicroStrategy trades at 2. Many of the others trade 4 plus, all the way up to 10 to 20 times. And so there's a very large range. As an investor, you should be aware of that valuation range. That probably these should all be somewhat similar. And so buying something at 20 times is probably less attractive than buying something at 4 times or 2 times. That said, the second metric that's pretty important is, valuation is one part, the other part is future growth. And so it's really taking a view on whether the growth in underlying Bitcoin per share or asset per share is growing over time, and how quickly it's growing over time. Because the faster you grow your Bitcoin per share, then the higher the premium that can be justified. And so it's really a combination of both. Just like in the traditional equity parlance, you buy things at a higher price to equity earnings or price to earnings ratio when it's higher growth company. For these guys that are quicker at growing their underlying Bitcoin share, you can probably pay a higher premium to NAV.
All right. Well, Cosmo, this has been such a great conversation. Thank you so much for coming on Unchained.
Yeah, thanks, Laura, for the time. This was a lot of fun.
Don't forget, next up is the weekly news recap, today presented by Unchained producer Pam Majumdar. Stick around for This Week in Crypto after this short break. BitKey is the only Bitcoin wallet on Time Magazine's Best Inventions list of 2024. Built by the team behind Square and Cash App, BitKey is a 2 of 3 multi-signature wallet and the first hardware wallet with an innovative recovery suite that eliminates the need for seed phrases in self-custody. Their new inheritance feature means BitKey's not just the easiest way to self-custody your Bitcoin, it's the easiest way to ensure it ends up in the hands of loved ones when it's time for it to leave yours. Learn more at bitkey.world. bitkey.world. Use code UNCHAINED for 20% off.
Welcome to this week's Crypto Roundup. In today's recap, we cover a $220 million exploit on Sui, Circle's IPO and USDC freeze, a federal judge overturning Mango Market's fraud convictions, and a shocking Bitcoin-related kidnapping case in Manhattan. We'll also look at Arkham's alleged doxing of Michael Saylor's Bitcoin holdings, Sam Bankman-Fried's potential early release, strategic Bitcoin reserves in the US and Pakistan, Kobe's new token sale platform, and one trader's dramatic rise and fall on Hyperliquid. Thanks for tuning in to the weekly news recap. Let's begin. Sui Network weighs bold move to reclaim stolen funds. Following a $220 million exploit on the Cetus decentralized exchange, the Sui Network is voting on a proposal to forcibly retrieve $160 million still held in the attackers' wallets. If approved, validators will execute a network upgrade that overrides wallet control and transfers the funds to a multi-sig wallet managed by Cetus, the Sui Foundation, and security firm OtterSec. The May 22 attack exploited flaws in Cetus's smart contract math, allowing the attacker to use fake tokens to withdraw real assets. Although $60 million was already laundered, the majority remains frozen. Support for the vote currently stands at 80%, with early passage possible by May 29. The proposal includes compensation to affected users using recovered funds, Cetus's Treasury, and a loan from the Sui Foundation. This unprecedented action has sparked debate over decentralization, with critics warning of future implications. Quote, taking a heavily opinionated stance to censor is a slippery slope, said David Rodriguez of Blockworks Advisory. Circle kicks off IPO bid and draws BlackRock interest. Circle is pushing ahead with its long-anticipated initial public offering, aiming to raise approximately $600 million through the sale of 24 million Class A shares. According to its latest SEC filing, the offering includes 9.6 million shares from Circle itself and 14.4 million from existing shareholders. If successful, the IPO could value the company at over $5.4 billion. Quote, becoming a publicly traded corporation on the New York Stock Exchange is a continuation of our desire to operate with the greatest transparency and accountability possible, said Circle CEO Jeremy Allaire. Investment giants are taking notice. BlackRock is reportedly planning to acquire up to 10% of the offered shares. The firm already manages a $53.5 billion government money market fund that backs 90% of Circle's USDC reserves. Meanwhile, Circle has frozen $57 million in USDC linked to Argentina's controversial Libra token. The freeze follows a court order tied to a lawsuit over alleged investor fraud involving Solana-based wallets. Judge overturns fraud convictions in Mango Market's case. A U.S. federal judge has vacated key fraud convictions against Abraham Eisenberg, the trader accused of exploiting Mango Markets for $110 million. The ruling, issued by Judge Arun Subramanian, found that New York prosecutors lacked proper venue to bring the case and that the evidence did not meet the legal threshold for fraud. There is no allegation that the Mango Markets platform had ties to New York, Judge Subramanian wrote, noting Eisenberg carried out the exploit from Puerto Rico. Attempts by prosecutors to link the case to New York through a user and vendor were ruled insufficient. Eisenberg was acquitted of wire fraud, with the court stating that the decentralized platform's lack of clear rules undermined the charge. Mango Markets was permissionless and automatic, Subramanian said. While the Justice Department may pursue the vacated charges in another jurisdiction, Eisenberg remains in custody, serving a 4-year sentence in an unrelated case involving child sexual abuse material. Crypto investor charged in brutal Manhattan kidnapping. A cryptocurrency investor in New York has been charged with kidnapping and torturing an Italian man in a bid to access his Bitcoin wallet. John Wolds, 37, was arraigned in Manhattan on Saturday and is being held without bail on multiple felony accounts, including kidnapping for ransom. According to authorities, the victim, Michael Valentino Teofrasto Carterin, was lured to a Soho townhouse on May 6, where he was allegedly ambushed by Wolds and accomplices. Carterin, a former fund partner of Wolds, was reportedly beaten, electroshocked, threatened at gunpoint, and even dangled from the top floor of the 5-story home. He told police that he was forced to smoke crack cocaine and had his leg cut with a saw. Carterin escaped on May 24 and alerted police. A third suspect, William Duplessis, surrendered days later. Authorities say the suspects aimed to extract cryptocurrency keys potentially worth millions. The investigation remains ongoing. Saylor rejects on-chain transparency as Arkham allegedly reveals Strategy's Bitcoin holdings. Michael Saylor, executive chairman of Strategy, formerly MicroStrategy, ruled out publishing on-chain proof of reserves, citing security risks. Speaking at a sideline event during Bitcoin 2025, Saylor called the practice a, quote, bad idea, warning that disclosing wallet addresses could expose the company to hackers, nation-state actors, and other threats. Quote, you publish your wallet, that's an attack vector, he said. Saylor argued that institutional-grade audits, not public wallet disclosures, are the appropriate standard for financial transparency. Just 2 days later, blockchain analytics firm Arkham claimed it had identified Strategy's primary Bitcoin address, reportedly holding 454,231 BTC worth $48.8 billion. Arkham further asserted it uncovered an additional 70,816 BTC, bringing the total to $54.5 billion, roughly 87.5% of Strategy's known holdings. The platform tagged addresses linked to custodians, including Fidelity and Coinbase Prime. Quote, Saylor said he would never reveal his addresses, so we did, Arkham wrote. The public disclosure sparked backlash online, with critics accusing Arkham of disregarding privacy and undermining the exact concerns Saylor had raised. Bankman-Fried could see early release. Sam Bankman-Fried, the former CEO of collapsed crypto exchange FTX, could be released from prison more than 4 years earlier than his original sentence, according to the Federal Bureau of Prisons. Initially sentenced to 25 years in March 2024 for orchestrating an $11 billion fraud, Bankman-Fried is now projected to be released in December 2044. The revised date reflects possible sentence reductions through accumulated good conduct time, credit for time served before sentencing, and a participation in prison programs. The Bureau of Prisons allows qualifying inmates to earn up to 54 days off per year for good behavior, though such reductions remain contingent on continued compliance. Bankman-Fried was convicted in 2023 on 7 counts of fraud and conspiracy for funneling customer funds from FTX into his hedge fund, Alameda Research. He is currently held at a low-security prison in San Pedro, California. His former associate, Carolyn Ellison, is also set for early release in 2026 after receiving similar reductions. U.S. and Pakistan advance strategic Bitcoin reserve initiatives. Governments in both the United States and Pakistan are formalizing plans to hold Bitcoin in official reserves. At the Bitcoin 2025 conference in Las Vegas, Pakistan's special assistant to the Prime Minister on blockchain, Bilal bin Saqib, announced the creation of a government-led strategic Bitcoin reserve. He stated that the reserve is intended for long-term holding and would, quote, never ever be sold. Pakistan has also allocated 2,000 megawatts of electricity for Bitcoin mining and AI data centers to support related infrastructure. In the U.S., White House crypto advisor David Sachs outlined how the federal government could expand its existing strategic Bitcoin reserve, which currently consists of around 200,000 BTC obtained through forfeitures. The reserve was established by executive order in March. Sachs noted that acquiring additional Bitcoin would depend on budget-neutral strategies developed by the Treasury or Commerce Department. Speaking at the same event, Vice President J.D. Vance urged Congress to pass pro-crypto legislation and reaffirmed the administration's commitment to firing regulators seen as hostile to digital assets. Kobe launches Sonar to reinvent ICOs. Jordan Fish, known in the crypto world as Kobe, has unveiled a new public token sale platform called Sonar, designed to modernize the initial coin offering model. Developed under his investment platform Echo, Sonar allows blockchain projects to self-host token sales using configurable tools for compliance and distribution. Unlike traditional launchpads, Sonar does not aggregate or promote token offerings. Instead, it enables projects to customize their sale terms and host directly on supported blockchains, including Solana, Cardano, and Hyperliquid. Quote, "At Echo, we don't really like launchpads. We think the incentives are a mess," the team wrote on X. Sonar's first live offering is from Plasma, a blockchain built for stablecoins. Co-founder Paul Fex said Plasma will offer 10% of its XPL token supply, aiming to raise $50 million at a $500 million valuation. The sale involves stablecoin deposits and lockup periods, with distribution set to follow Plasma's mainnet beta launch later this year. Time for fun bits! Trader turns $87 million win into $13 in record time. James Wynn might want a name change. The crypto trader racked up a staggering $87 million in profits on Hyperliquid in just 70 days, riding high on meme coins and 40x leverage. But then came the plot twist: he lost it all in 5. According to Look on Chain, Wynn's fortune vanished between May 23 and May 28, leaving him with a wallet balance better suited for a vending machine. His latest claim to fame? A $529 million Bitcoin position that's underwater by $2.1 million, and just $13 left in realized gains. Wynn bet big on coins like Pepe, Trump, and Fartcoin. The market clapped back hard. Turns out the only thing hyper about Hyperliquid was the speed of his downfall? Ouch. And that's all. Thanks so much for joining us today. If you enjoyed this recap, go to unchainedcrypto.beehive.com. That is unchainedcrypto.beehive.com and sign up for our free newsletter so that you can stay up to date with the latest in crypto. Unchained is produced by Laura Shin with help from Matt Pilchard, Juan Aranovich, Margaret Curia, and me, Pam Majumdar. The weekly recap was written by Juan Aranovich and edited by Stephen Ehrlich. Thanks for listening.